Shrinkflation is not a mistake. It is not an accident of inflation. It is a deliberate corporate strategy with a name, a playbook, and a profit motive. In earnings calls, they don't say shrinkflation. They say revenue management initiatives. They say price pack architecture optimization. They say value engineering. But the result is the same. You pay the same price, you get less product, and the company books higher margins. This has been happening for decades. In 2026, it's accelerating, and the system that produces it is more elegant and more cynical than you think. Let's start with what's actually happening. Not theories, receipts. Gatorade. The 32-ounce bottle became 28 ounces. The price didn't move. A bag of Doritos, 9.75 ounces became 9.25 ounces. Same shelf price, less corn. Cadbury creme eggs. A 6-pack became a 5-pack. Same box dimensions, 1 egg gone. Tropicana orange juice. The half-gallon became 52 ounces. That's 12 ounces of air where juice used to be. The carton looks identical. These are not isolated examples. Consumer advocacy groups have documented hundreds of shrinkflation cases across every aisle of the grocery store. Cereal boxes got taller and thinner. Same front-facing area, less inside. Toilet paper rolls got narrower. Coffee cans shrank from 16 ounces to 11.5. Dog food bags lost half a pound while keeping the same price tag. This is not random variation. This is not supply chain issues. This is a business decision made in boardrooms and then executed across thousands of SKUs simultaneously. And here's what makes it remarkable. They all do it at the same time. When Mondelez shrinks a product, PepsiCo doesn't advertise that theirs is still full-sized. They shrink theirs too. The entire industry moves in lockstep, not because they're colluding, but because they're all reading from the same playbook. That playbook has a name. In the consumer packaged goods industry, it's called price pack architecture. And it's been refined over decades. Here's how it works. Step 1. Input costs rise. Wheat gets more expensive. Oil goes up. Labor costs increase. The company's margins start to compress. Step 2. The company faces a choice. Raise the price or shrink the product. Decades of consumer research tell them the same thing. Shoppers notice price increases more than size reductions. You'll notice if your chips go from $4.99 to $5.49. You probably won't notice if the bag loses half an ounce. Step 3. The packaging team gets to work. They redesign the container. They add a deeper indent in the bottom of the jar. Same external dimensions, less product inside. They puff more air into the bag. They reshape the bottle so it looks taller but holds less. Step 4. The new package hits shelves. The price is identical. The front of the package looks the same. The only change is a tiny number on the back, net weight, that almost no one reads and even fewer people remember from the last time they bought it. Step 5. The company books the margin. On 1 bag of chips, half an ounce is pennies. On 100 million bags a year, it's tens of millions in pure profit. This is the playbook. It's not a secret. The companies discuss it openly in investor presentations. Kraft Heinz calls it price pack architecture optimization. Mondelez calls it value engineering. PepsiCo calls it revenue management initiatives. Same machine, different nameplates. Now let's go deeper. Because the playbook isn't the system. The system is the thing that makes the playbook inevitable. Here's the architecture. 4 nodes, 1 closed loop. Node 1, quarterly earnings pressure. Publicly traded consumer goods companies report earnings every 90 days. Every 90 days, they must show growth. Not just profit, growth. Revenue growth, margin growth. If they don't, the stock drops. The CEO gets questioned. The board gets nervous. Node 2, volume constraint. There is a hard ceiling on how much stuff people can consume. You can't sell more soda to a country that's already drinking soda. Population growth is slow. Market share shifts are expensive and slow. Organic volume growth in mature categories runs at 1 to 2% a year. That doesn't satisfy Wall Street. Node 3. Price sensitivity. You can't just raise prices forever. Consumers have a breaking point. Research shows that shoppers are roughly 4 times more sensitive to price increases than they are to size reductions. This is the key asymmetry that makes shrinkflation possible. Node 4. Margin expansion via hidden means. If volume can't grow fast enough and visible price increases trigger consumer backlash, the only remaining lever is invisible price increases. Shrink the product. Keep the price. The revenue per ounce goes up. The margin expands. Wall Street is satisfied. And here's the loop. Margin expansion in Q1 raises expectations for Q2. The company must show growth again, but volume is still constrained, and consumers are still price sensitive. So the company shrinks the product a little more. And the cycle continues. This is not a conspiracy. It's a structural inevitability. Any publicly traded consumer goods company that chooses not to do shrinkflation is choosing to underperform its peers. The CEO who says, "We're not going to shrink our products," is the CEO who gets replaced by someone who will. The system doesn't require evil people. It just requires quarterly earnings targets and a product that can be shrunk. Let's make this concrete. One product, 1 year. A bag of chips sells for $4.99. In 2024, it contained 9.75 ounces. The company sells 100 million bags a year. Revenue, $499 million. In 2025, input costs rise 4%. Wheat, oil, packaging, transportation, all up. The company has 2 choices. Choice A, raise the price to $5.19. Revenue goes to $519 million. But volume drops 6% because shoppers switch to a cheaper brand. Net revenue, $487 million. Profit shrinks. Choice B, keep the price at $4.99. Shrink the bag to 9.25 ounces. Half an ounce less. The input cost savings on 100 million bags, roughly $8 million. Volume holds steady because nobody notices. Net revenue, $499 million minus $8 million in saved costs. Profit grows. Choice B wins every time. Not because the executives are greedy, because the math makes it the rational decision. And because the alternative, raising prices visibly in a competitive market, is the fastest way to lose market share. Now repeat this math across every SKU in the store. Cereal, juice, crackers, frozen meals, pet food, laundry detergent, paper towels. Every product category where the package can be subtly redesigned. Every category where consumers track price but not weight. The cumulative profit impact across a company like PepsiCo, with $23 billion brands, is in the hundreds of millions per year from making things slightly smaller. That's not a mistake. That's a machine. Study after study confirms that consumers are terrible at detecting size changes below 10%. Shrinkflation operates almost entirely in the 5 to 10% range. The sweet spot between meaningful margin improvement and consumer detection threshold. You're not supposed to notice. The entire design system is built around that fact. So what do you do with this? 1. Read the net weight, not the package. The only number that matters is the one on the bottom of the front label in tiny print. Ounces, grams. That's the product. Everything else is theater. 2. Compare unit prices. Most grocery stores list the price per ounce on the shelf tag. That number tells you the truth that the package design is hiding. 3. Understand that this system doesn't stop unless consumers force it to stop. When Mondelez shrinks Cadbury eggs and sales don't drop, the behavior is reinforced. The only vote that matters is the one you cast at the shelf. Shrinkflation is not a mistake. It is not a conspiracy. It is a system, a closed loop of quarterly targets, consumer psychology, and packaging design that produces smaller products as reliably as a factory produces anything else. The system is not random. This is behind the spends. Decoding the systems behind spending.